What if I told you that right now you might be working 61% harder than you need for retirement? And that's not a random number. This number comes from a groundbreaking new research that is titled Beyond the Status Quo, a critical assessment of lifestyle investment advice. This paper actually analyzed 130 years of data across 39 countries. They found is traditional retirement advice that you've probably heard or you're following right now could be forcing you to save 61% more than you actually need. Your retirement strategy probably looks something like this. For most people, either you're using a balanced portfolio of stocks and bonds, or you're just using a simple target date fund that automatically moves your money to bond as you age. If that sounds like you, you're not alone, because a lot of people actually invest this way because we've been sold that that's the safest and that's the best. And this is what most financial advisors actually recommend. And also it's what most retirement plans that you would buy off the shelf, this is what they default to. And this is exactly why you might be working way harder than necessary. First, let me explain why this conventional wisdom actually became so popular and why on the surface it makes a lot of sense. The theory around this conventional wisdom says that when you're young, in your 20s, in your 30s, most of your investment should actually be in stocks because you have a lot of time ahead of you. And as you get older, you transition to a lot more conservative investment. And that's sensible. It looks something like this, right? As you can see on your screen. In your 20s, 30s, you have 80 to 90% stocks, while 10 to 20% bonds. And maybe in your 40s and your 50s, you move that a little bit to 70 to 60% stocks, while you have like 30 to 40% bonds. And then in your 60s and beyond, when you're close to retirement, you go to something like 50% stocks and 50% bonds. And there are even some gurus out there that would even suggest just 50% stocks and 50% bond right from the beginning. And the reason for this is stocks are considered to be very risky and are known to be volatile. You know, one day the stock markets, your stocks are up, you're up, and the next you're actually down. For example, just imagine in the 2008 financial crisis, right? The S&P 500 actually dropped nearly 58% in about a year and a half. Now imagine you're a 65-year-old about to retire and all your fund is invested in the S&P 500 at this time, and suddenly you realize that half of your life savings is wiped out. That's very scary. Now, this risk I've just mentioned is only a problem for you if you need to withdraw your money in the short term, let's say like between 2 to 5 years. So you don't want to be that guy that wants to withdraw your money in 2 to 5 years and something like that happened in the 2008 financial crash actually happens. And to mitigate this, you want to have cash and savings for about 3 to 5 years into your retirement, so that if something like that happens, you're not forced to sell your investment when it's low. But if you're investing for decades, maybe you're in your 20s or 30s, this doesn't matter. Another reason why people are advised to reduce their stocks as they get older is because bonds are considered safe, right? So therefore, what that means is as you get older, more bonds equals more safety. But here is where it gets interesting. And let's make this real by using a simple example. Let's say you need £1 million for retirement. Your retirement pot that you're aiming for is £1 million. Following this traditional advice of reducing stocks and increasing bonds would mean that you would have to save £1,000 monthly, assuming let's say a 6% return for about 30 years. This means that some years will definitely earn more, definitely while you're a lot younger, but as you get older and you transition to bonds, your returns would actually reduce. But with the strategy that have been outlined in this research, you would only need to save about £620 monthly, give or take, or even less to get to the same goal. That is £380 less every single month, or £4,560 less every year. And that money could be going towards maybe your current lifestyle, your children's education, maybe that vacation that you've been postponing, right? Or anything else in particular. Now, you're probably wondering two things, and I had the same concern. How is this possible, one? And why should I even trust this research in the first place? Before we address those questions, please, if you like the content that we put out here on the Wealthy Post, hit the like button, hit the subscribe button for more financial insight like this. We deep dive into research, we tackle questions that makes you grow wealth and live a meaningful life. Okay, let's tackle the second question first. The study tested its conclusions by adjusting multiple factors in its analysis. They did this to see if the results would change, but the findings were constant. The factors that they adjusted for were different retirement age, different statistical sampling techniques to test whether their results were dependent on one specific method of data collection, various withdrawals from fixed percentage to flexible withdrawals based on market conditions, multiple household types, whether you're single or a married couple, different income levels, various market conditions. They tested different levels of investor risk tolerance. They also looked at different desires to leave an inheritance for your loved ones. They also tested different savings rates, and the results held up every single time. They compared their findings against other major databases to validate their accuracy. In other words, this is as robust as research can get. Now let's get to the exciting part. How is this possible? How is it possible to invest less monthly and still reach the same goal? These guys discovered that the optimal strategy was actually 33% in domestic stocks, which I'm assuming is the US since they are based in the US, and 67% in international stocks and 0 bonds. Yes, you heard that right, 0 bonds, no bonds investing. And before you think that sounds risky, wait till you hear this. This strategy wasn't just better for growth, it was actually safer for retirement. And the solution is actually simpler than what you're probably doing right now. First step would be choose a low-cost index funds, right? One for the US like the S&P 500 and another one for the international markets. Step 2 would be to set your allocation. 33% for the US stocks, which will be the domestic stocks according to the research, and 67% for your international ETF that you've chosen. And step 3, just stay consistent and rebalance once a year. Don't chase trends, trust the process, trust the data, trust the research for over 130 years worth of data. But then what happens when the market drops, right? The researchers tested this strategy against every major market crisis in the last 130 years. The 2 world wars, the Great Depression, the 1970s inflation crisis, the 2008 financial collapse, the 2020 pandemic, and everything in between. They also tested it across different countries, different economic conditions, different political systems, different market structures, and the results were consistent every single time. This strategy is not about taking unnecessary risks. It's about understanding what the data actually tells us about long-term investing. So it's over to you, right? What should you do with this information? First, I would check my current retirement strategy. This could be in your pension pot, this could be your ISA, whatever it is, especially your pension, because if you're in a default fund, most likely you have bonds that you're invested in. Or maybe you're doing DIY investing and you just decide, I'm just not going to bother, right? I'm going to just pick a target date fund. They have bonds and they actually readjust and add more bonds as you get older based on your target retirement. And if any of the things that I've mentioned sounds familiar to you, it means that you're holding bonds, right? And that means that you might be working 16% harder than you need to be So consider reviewing your current allocations. Look into low-cost international index funds. And that's it. If you found this valuable, please hit the subscribe button, hit the notification bell, and drop a comment with your biggest takeaway. And remember, working harder isn't always working smarter, right? And also don't forget, I'm going to be linking that report in the description so you can read for yourself and make your own choice.